What is going on, guys? The market took an absolute dump today, but I went and bought a stock, Maggie. For those who are new, I'm trying to build up my Maggie position to about 150 to $175,000. I bought a little over $4,000 today, so hopefully I'll reach my goal quicker, right? Welcome to my channel. If I didn't say that already, I'm the covered call guy. I'm trying to create a $120,000 passive income portfolio using only covered call ETFs. Right now, my portfolio yields about $72,000 a year, about $6,000 a month, about $1,400 a week, and about $200 per day. I will be updating this at the end of every month, so hopefully, fingers crossed, that I cross $75,000 a year. So I will be updating that. Let me look at my calendar. About 2 weeks, right? 2.5 weeks. All right. This legal disclaimer before we start this video. This content is for informational and educational purposes only and should never be considered financial, investment, or tax advice because I'm not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete, or just flat out wrong. Investing and trading involves significant risk, including possible loss of principal, so please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Because remember, I'm just some random idiot you found on YouTube, and I could be completely wrong. Now, with that out the way, today's video is going to be on 6 ETFs. They are all structured income ETFs. They they don't all use autocallable, but the 6 of them have a autocallable and barrier strategy. I will get into that. Simply put, if these are new to you, it's a structured notes in your ETF, and I'll get into what structured notes are because that is actually quite a new thing. It used to be only rich people could buy these type of structured notes and coupons or bond-like notes. Anyways, how it works, right? Your 3-step income. I'm going to be showing you the machine that mimics high-end structured notes without the bank risk, because you had to be wealthy back in the day to actually get into buy these type of structured notes, right? So 1, your income, right? I don't buy the stock here. I sell options on them. This generates your 10-15% monthly cash flow. 2, your safety net. You get a 30% buffer, right? This is the barrier, right? Your principal is safe unless the market crashes through this barrier. Your reset, the market goes up, your trade ends early, I cash you out and automatically start a new cycle. And who is this for? The target audience? Well, you, if you want volatility premiums and limited downside. So this is how I think it operates. I could be wrong on this. So again, if I'm wrong, let me know. But I think this is how, for the most part, all 6 kind of operates this strategy. All right, structured product 2.0, your evolution. This is what I was talking about. And my picture doesn't load, even though what it did. I don't know what's wrong. What's wrong? Can I click on it? No. Okay, the old way, right? You were locked out. All right, I want you to see how this changed. Historically, structured notes were only for the wealthy. Banks sold them OTC, over the counter. They were opaque. You couldn't price them, and illiquid. Your money was locked up. Basically, if you were wealthy, you had a private banker, right? So pretty much an accountant, right, or a private banker would handle your money for you, buying this for you. You know, someone poor wouldn't be able to buy, or would buy, or have the money to buy notes. And these are the new. These 6 ETFs are the new way. You're witnessing a massive migration, as you see. This is a $1 trillion business, and billions are coming into income ETFs. This is basically a different version of income ETFs with different strategies. All right, your Vanguard lineup, right? CAIE from Calamos Autocallable Income ETF, Simplified Suit, SBAR, XXV, your Barrier Income, and Innovator Suit, ACII, ACEI, right? Autocallable Strategy. All right, so I'm presenting the tools available to you right now that's offering about 9 to 25%, give or take. It ranges. And I like that 9 to 10, 11, 12%. For those who are new, I'm very conservative when it comes to the yield, right? I talk about real and fake yield a lot, so a lot of that matters because I want to be holding these for 30, 40, 50, 60. And if I live that long, 70 years, I don't know. In 70 years, I'm in my early 30s, I'll be 100, pushing over 100. So who knows? All right, solving your yield famine. And what do I mean by that? It's just you're split into two sides, right? One, you feel stuck, right? Bonds. If interest rate rises, your bond price crashes. You face duration risk. Stocks. If the economy slows, your dividend gets cut. You face beta risk. So I want you to, I know you need income that doesn't rely on the Fed or a bull market. And the solution, selling fair, right? I'm giving you strategies that are duration neutral. We don't care about rates. We monetize fair for you. That goes with the VIX or VRP, right? Volatility risk premiums. You sell options when fear is high. The correlation risk, however, you bet that assets won't all crash at once because it can happen. Right? For those who are new, you probably only faced the April, and for those who invested a little bit longer, 2022, right, and 2020, and so on. You get my point. The result, if the result you get double digits yield basically from selling when fear is high. That's all it is. All right, your auto callable blueprint, right? Think of this as your contingent bond. You get paid a high coupon, but I want you to know the rules, right? Your happy path, market flat or up, you get your money back early plus the coupon. I reinvest it automatically. Or 2, your income path, market down but safe, you keep getting paid monthly coupons as long as you are above your barrier. And 3, your third path, your pain path. Market crashes below 30%, you stop getting coupons and lose principal 1-for-1. This is it, right? That's why I split into 3 paths for the 3 types of ETFs that you can build around. All right, deep dive into CAIE. It is the big dog here. It has $465 million assets under management. Yes, that matters because of the bid-ask spread price, right? The bigger the typically the cheaper the bid-ask spread is and the more profit you keep. Let's think of it that way, right? If you want liquidity, CAIE is your leader. It uses total return swaps to replicate the index, right? This minimized tracking error for you. And the key stat is you see a 14.25% distribution rate versus almost a 3% SEC yield. The difference is your option premium, that payout. That is the actual yield. Your risk, all right, we always got to talk about the trap, right? The decrement trap. What that means is the 35% volatility target. You're exposed to an aggressive 35% volatility target. This generates your high premiums but makes your fund sensitive to drawdowns. And on top of that, the 6% drag, right? I need to warn you about the catch because not a lot of people think about this. The index applies a 6% annual deduction. This is the cost to subsidize your coupons. So face the reality. If the S&P 500 is flat, you lose 6% in index value. That's 30% drag over 5 years. I don't think a lot of people are talking enough about that. Simplified barrier mechanics, SBAR. How worse off works for you. All right, so right here, you aren't buying a synthetic index, right? We sell the barrier put on a basket for you. S&P, NASDAQ, and Russell 2000. Obviously, I'm not selling it when you buy these ETFs. That's what I'm kind of talking from ETF point of view. So I just want to clear that up because I know I'm going to get something in the comments. All right, your bet here is that if you buy it, you get paid a 12% plus yield as long as the worst performing index stays above your barrier. All right, why do this? You get a higher premium than selling puts on just the S&P 500. Your risk, you're shorting dispersion, right? If small caps crash, you lose money. So it's a bet. That's why you get the high yield. The bigger the bet, the bigger the payout. SBAR, it's about 79% rock advantage, right? So about 79% is estimated return of capital. That's good for you, right? Your tax deferred power, right? So I'm estimating 79% based off of the estimates that they're giving. This isn't tax immediate for you. It lowers your cost basis. You only pay capital gains when you sell. If you have a taxable account, this is critical for you, right? You want I don't know anybody who wants to pay taxes. If you want to pay taxes, just give me the money. Serious. And then we talk about the high octane structured income ETFs, XV and XXV. XV literally target 15. I don't know if people realize that, but it took me a bit to realize that. Maybe because I'm slow, right? So I was like, what? Why did they name it XV? Literally 15. Oof, right? That took me a while. I was like, XV, that's a nice name. Why did they name that? Oh yeah, it means literally 15. Target 15. Oh my god. Right? So if you want 15% XV, target it using dynamic barriers in a calm market. They tighten the barrier on you to hit that target. And then XXV, right? Same way. I was like, why did they name it XXV? Oh yeah, 25%. That literally means 25. If you want 25%, this is your tool. I'm gonna say beware. It operates on the bleeding edge, right? You are highly sensitive to Vol-Magdon, Vol-Agdon, or however you say it, Agdon spikes, which just means that if the VIX is over 100%, right, which can happen, it doesn't happen often. I think the last time it happened when the VIX was like near 100, over 100, was like either in 2018 or 2019, one of those years, right? So it doesn't happen, but it can, and it just means once that happens, XXV, it's gonna kind of operate on a bleeding edge. You're gonna be it's gonna be extremely sensitive, and you might lose on both the payout and your capital appreciation. So it's a double-edged sword here. All right, your risk here, you should treat these two as a tactical satellite holding, not your core income, right? You're taking an extreme risk for these yields. These are for more of like turbo boosting your yields and your payout. I would say like if you, for example, like if you had $10,000, put $10,000 into each and you just leave it like that. Don't touch it. Don't reinvest. Just let it play out, let it pay out and play out. So that's how I would approach these two. All right, then we talk about the Innovator suit, ACII and ACEI, right? These two, I'm gonna say the biggest warning here is liquidity, right? I want to be careful with these two because they struggle with sub 10 million assets under management, right? So this is two issues here, right? Liquidity risk and the wide bid-ask spread can erode your returns, right? For ACEI, it is also a single stock risk. ACEI reference single stocks like Tesla. A 30% drop in the S&P is rare. A 30% drop in single stock you own is common. So understand the two difference here. Your probability of a breach is much higher here. I don't think people think about this when they buy these type of ETFs, right? It's about the breach. Then you get called away essentially, and you start dropping one for one. And here I just compile how they stack up against one another and their strategies, right? The headline yield. I'm missing XXV. I just noticed that now, but I think you get the point with XV. So you see the headline, the barrier, the structure, the liquidity. Obviously, CAIE has the highest liquidity, right? And for the most part, they are in line with the yield with one another, except for XXV, that's 25%. In my opinion, I probably would go towards CAIE if I had to pick out of the six. If I had to pick one, that's just, I guess, my preference. One of obviously the big headline yield is pretty decent. I'm gonna say it's still pretty conservative. The barrier is good. Structured, however, I don't like how it does the swap, but it does the index. So that's, I guess that's not bad. Let me know what you guys would pick or have if you guys already own this. I don't own any of it, but if I had to pick one, I'll probably pick CAIE. And I was feeling risky. I want to turbo boost my yield. Either XV or XXV, either one is fine with me. I have no issues with picking either or. Probably XXV since it's higher than actually consider it turbo. Alright, what makes these different for you? Strategy and risk. right? Your structured derivative funds. These 6 funds are derivative funds, right? They're a little bit more complicated, right? The strategy, right? They use a auto-callable replication swap or option spread to sell barrier risk. The objective here is that you get high monthly income by monetizing volatility, not dividends. The risk, barrier breach, return of capital, and structure, right? So barrier breach, you can take one-for-one losses beyond the barrier, right? So the structure, not simple equity exposure. And we'll talk about simple equity exposure like this one. Compared to equity income like SBAR, right? The cover call alternatives, SBAR and QQL are different. They own the actual stocks for you and sell calls, right? Equity income like SBAR, your risk is simple. If the market drops, you drop. That's premium, right? You have no barriers. Versus structured income like CAIE or SBAR, your risk is cliff risk. You are safe until you're not, right? You're safe until the 30%, then you get breached, then you crash hard 1-for-1. All right, how to compare for you, comparing SPY and QQI. My takeaway, SPY and QQI are just completely different beasts, right? One is call equity income, and the other one is structured derivative income, a little bit more complex. I wouldn't really entice newbies to be investing in these until they actually understand the structure behind it. I'm not saying they're bad. I'm just saying when it comes to a little bit more complex derivative strategies and actually how they are kind of executed, I would say the newbies would probably have to do a little bit more deep dive than this and understand, you know, go and get your foot wet with the easier to understand cover calls first before you go into a little bit more, in my opinion, complex strategy and derivatives. All right, how they fit in your portfolio. Again, this is my opinion. Okay, this is kind of like my analysis and my market scenario. If you want income and upside, use SPY and QQI. Right, you're an income first investor who still wants a simple equity exposure. These two, or just cover call ETFs in general. Simple cover call ETFs. If you want max yield plus structure, then of course CAIE, SBAR, XV. Right, you understand derivatives and are willing to take structural risk for yield enhancement. And of course, for those who are much more seasoned investors, diversification, right? You should consider a mixed allocation, diversify your income sources, but keep strict size limit on structured funds, is my opinion. That's how I would approach this for diversification. All right, structural risk you face, right? The counterparty risk, using CAIE. If the swap counterparty defaults, you lose swap value. However, Rule 15F-4 requires collateral, so making it safer for you than old over-the-counter notes. Knock-in psychology, right? This is the risk. This is more the personal emotional risk here, but it's real. Imagine the market drops 29%, you are fine. At 31%, you crash. This is the cliff risk, right? This creates the panic for you. In CAIE, the detriment creates a slippery slope. That's why I say just stay away from it if you're a newbie, right? Learn to control your emotions with a 1 to 5% drop, and then a deep correction at 10% drop. And then once you get seasoned enough, you can handle and you actually buy the dip, like what I did today. And you're like, a red day, I'm buying. A green day, I'll go back to sleep. Right? So that's what I meant by that in the earlier slide. My final verdict for you, your income champion would be CAIE. Why? Because it's the category killer for you. With 465 million in asset, it has the liquidity you need, and the 52-week ladder smooths out your risk perfectly. If you are the tax player, SBAR. Why? If you are a high tax bracket, if you are in a high tax bracket, right, that 79% return on capital is unmatched for you. It boosts your after tax significantly. And of course, you can have both. Nothing wrong with that. I'm just doing a devil's advocate and split into both. And you have to pick one. These would be the two choices. My bottom line, I would treat these as equity insurance sellers, right? Meaning you get paid a high premium because you are taking the risk of a market crash. How often it crashes? Not often, but it happens. And this is just that appendix, right? How your coupon is built, right? So I talk about the coupon a lot. Just think of it as your 14% yield as a paycheck built from 3 distinct sources. One is your interest, 4%, right? Remember the collateral it has to hold. We start with a safe cash interest from your treasury collateral. And then 2, selling crash insurance at 6%. You sell a barrier put, you get paid premium for promising to take losses if the market crashed 30%. Okay? You're going to take on the full weight of the crash. Selling the upside, 4%. You sell in an auto call option, you get paid for giving up the chance to double your money. So in simple terms, your total coupons equal interest plus crash premium plus upside premium. Right? A little bit more complicated than your average cover call ETF. And that's what I mean by that. Of course, it could be a little bit more complex. This is just a simply put. And this is the way I see it. I could be wrong on this. And if I'm wrong, please let me know. Alright, that's the end. Thanks for watching. Subscribe, like, and comment. I hope this was educational and informational. I've only really known about CAIE because it was I like to look at the assets under management, and I always choose from my view, I say those are the safer route. The bigger the typically safer it is, right? So out of like the 6, I've really only known about CAIE and only really known about doing it, the deep dive before all of this. I did hear about XV and XXV, but because of how it just didn't pique my interest for turbo, for those type of yields. I went with Maggie and BTCI. But yeah, I hope these 6 ETF are a little bit more well known to you now and now on your radar. And if it's been on your radar or if you already own it, let me know how it's been treating you. Again, fact check me. I could be wrong on a lot of things. And if I am, let me know. Makes me a better investor. And if I can be a better investor, hopefully I can make someone else a better investor. Thanks for watching. Catch you guys up next. Stay tuned.